so jealous recently. My sister's gone to like the Patriots playoff game, all the Celtics games, like the past like weeks.
Really?
Like she was at the Pacers Celtics one day. I'm just like,
Okay, good morning, everyone. If you haven't realized yet, I do start on time, and end on time. There's an old football coach who says, if you're early, you're on time. If you're on time, you're late. If you're late, forget about it. So things, again, transition into the workplace. Always try to be on time. A couple of administrative things. Is everybody clear? Is anybody waiting on registry for the class or wait list or anything like that?
I'm on the wait list.
Okay, that should be getting cleared up. So you're fine. I got all the approvals. I think the administrative folks are just, swamped right now. But wait list is going to be cleared and everybody will be okay. Keep coming to class. Okay, textbook. I put in the syllabus the 15th edition. The topics we're going to talk about right now, what you find in tax, which makes it so hard for textbooks, is tax is moving all the time, right? So we are in 2026. So the way I'm going to teach this course is if you're graduating and you're happen to be going into something that's going to touch tax, you will probably be involved in doing 25 tax returns in that whole process because we're in arrears all the time. We're doing 26, corporations will be doing their 25 tax return all the way up until October 15th. So they don't usually start until summer, fall. But so I need you to know what is the 25 rules in case you're in that position. But we were also in 2026 and we know we had a big piece of tax legislation, so the law has changed. So I'm going to be teaching you 25 and 26 in the slide decks. The trick on the textbooks is the 15th edition is 25. It doesn't have the new stuff in there. So the 16th edition, I believe the bookstore is going to have that in a couple of weeks. I will try to get that clarified exactly. So the 16th edition will have the 26th, or the tax changes that I'm going to start with today. So the way I would approach that is you're going to be fine with the 15th edition. It's available, you can get it, and you'll be fine supplementing that with the slide decks. But if you happen to think you might be going into tax, or interested in international tax, you might want to hold off a little bit and get the 16th edition. That'll be more of the new stuff. So I know that's frustrating, but that's just part and parcel of being a tax person. Is they change the law quickly, like we talked about last time, more so than accounting principles. Okay, I want to start with this on the course introduction because this was a major piece of legislation last summer. It was signed by President Trump on July 4th. It went through Congress via the budget reconciliation rules. What that means is they can go through with a simple majority of voting for it. And as you know, as you probably know, the majority of the Republicans in the House of Representatives is very, very thin. They have it's just a few seats. So they wouldn't get the normal 60% needed to pass legislation. So they went through budget reconciliation. And you can only do that so many times in a Congress. And so they used one of those for this bill. The impetus for this bill was back in Trump 1.0 in 2016 when he was elected. They passed major pieces of legislation called the Tax Cuts and Jobs Act. Everybody calls it TCJA. And by the way, don't get too struck by the name of legislation. It's odd because it's very, very political. It doesn't necessarily tell you exactly what's in the bill. One big, beautiful bill act. What does that tell you that's in the bill from a substance standpoint? Nothing. Okay, so Tax Cuts and Jobs Act. Tax cuts are favorable for voting public. Jobs favorable for voting public. So that's why they put those words in there. But anyway, they did that in 2017. And but as part of the budget reconciliation procedure, you have to be budget neutral over a 10-year window. So they start playing games with the budget. They will enact something and then have it change within the 10-year window to be more taxpayer or more government favorable in the later years. and then they average that out so it's budget neutral over the 10 years. So what happened is, they changed the law in 2017. A bunch of the provisions were temporary. What I mean by temporary is they passed the law, and the terms of that law, by their own words, change in the future, just waiting for the calendar to change. And one of those big years where it was changing was January 1 of 26. And it doesn't seem like it's a long way when you're from 17. Oh, that's 2026. Well, we get there eventually, right? And so a lot of the provisions that were going to raise the income tax burden on individuals was going to start on January 1st. So that was the impetus for this bill. We have a government now where they almost have to be forced to do something because there's not a lot of compromise between the two parties. And so the parties came together and knew they had to do something or tax rates were going to go up for individuals. The tax burden was going to go up. Business knew that, so they were right in line with their wish list to tag onto that bill as well. So hence, the One Big Beautiful Bill Act. You can probably guess by the terminology that the president was very involved in this bill. It's extremely taxpayer favorable for individuals. You guys may have been hearing in the news that there's going to be a big refund season coming up from people filing. The reason they did that is because they passed this bill on July 4th and then they didn't change the withholding tax tables. So people have been getting over withheld during the latter part of 2025. They file their tax return in 26. The tax rates are going to be lower and it's going to cause a bunch of refunds. So Republicans I think are counting on this to be the whole affordability debate in the marketplace, that they're going to be really pushing that people are going to have bigger refunds, and you can already see it in the pep rallies that they're having now. Okay, long story short, we have corporate provisions that piggyback on top of that individual income tax impetus for the bill. On the international tax front, there are major areas that were changed, and they are largely corporation favorable. Because business came with their list of things, these are what I want, and they've been working really hard behind the scenes, knowing this day would come, that the government would have to move because of the individual tax changes that would otherwise occur. Okay, so I know you don't know these rules yet. You're not expected to know these rules yet, so we're sending this half semester on, but I want to give you a flavor of the change that this legislation happened. Okay, and so the first is in what is called the GILTI regime and the FDII regime. There's lots of acronyms here because and unfortunately when they passed the law in 2017, they purposely chose the words of the regimes to fit into an acronym that had a catchy phrase. So you see GILTI here, G-I-L-T-I, not spelled correctly, but can be called GILTI. And the idea was that most multinationals, the perspective of the drafters of this legislation, were doing too much on the international tax planning front and not paying the right amount of U.S. tax. Hence, they were guilty. So they changed the law to increase that tax burden. Okay, so the government changed the rules on the GILTI regime in the One Big Beautiful Bill Act. They also changed what we're going to talk about in advanced international taxation. If you're going to take that course, FDII is a export benefit from the United States. So think U.S. manufacturing sales abroad. Who do you think would be in favor of that? The Trump administration, right? They want jobs in the U.S. They want you to make things in the U.S. And if part of that is you selling it outside the U.S., that's great. But make it here, hire people here to do it. So what did they do? They made an incentive in the tax code to where we tax that activity less heavily. The government always messes with the tax code to try to change taxpayer behavior. So if they have a particular political view as to what they want to do, if they incentivize U.S. activity, they will change the laws to try to make that more attractive. Think if I dangle the carrot on front of business, they will do that. Or you could do the other way, not the carrot, but the stick. If you do something I don't like, I want to tax you more heavily. Right? So they can do that as well. Foreign tax credit, we're going to spend some time on that in this course. Obviously, it's a big part of outbound tax planning. The foreign tax credit rules are meant to alleviate double taxation. So if I'm doing activity in 2 jurisdictions, which we're going to talk about later today, I am susceptible to being taxed twice on the same item of income. The way the U.S. principally alleviates that exposure is through a foreign tax credit. We allow another country to tax it initially, and then we offset that tax against your U.S. tax liability to try to mitigate the instances of double taxation. The rules in the foreign tax credit world were revised in this bill, largely, again, corporate favorable. Again, think about corporations being ready to go and lobby for this. They've been spending a lot of money educating the politicians on this and getting these ideas across. The last big area is a provision called the BEAT. And again, that's the stick. You eat somebody with the stick. But that stands for Base Erosion and Anti-Abuse Tax. That's a regime in the United States where they thought payments from the United States that were deductible against U.S. taxable income, or payments a U.S. company would make to a foreign party, were too large. And so they increased the tax burden via this BEAT regime. We're going to cover all of these this half semester in more detail. But they changed these rules, and this was really, when we talked about these Pillar 2 provisions a little bit Monday, this was in response to that. The U.S. used this stick of BEAT to get the OECD to accept that the U.S. rules were close to the Pillar 2 objective that we talked about last class period. So all this stuff has got a very political thing. And if you happen to like, you don't have to like politics, but if you like the mechanics of how government works, tax is, again, fascinating for that, because all of this stuff is the function of our government. And guess what? In this bill, like I mentioned on the Tax Cuts and Jobs Act, not one Democrat voted for the bill. So if you're going into tax, you can envision what happens. The Republicans won't always be in control. Government changes hands at certain points. Once the Democrats get in control, they will start attacking some of these regimes with changes. And you have to learn those, but it's not a bad thing. It's job security, right? Okay, so I want to go a little bit through some of the changes here, just real briefly. I know you don't know the rules yet, but I want to give you a flavor of what happened in this bill. So the Global Intangible Low Taxed Income, the GILTI regime that was enacted in 2017. So I put pre One Big Beautiful Bill Act and then the post One Big Beautiful Bill Act. I've heard some firms are calling the One Big Beautiful Bill Act OB3 because there's 3 B's in there, Big Beautiful Bill, so OB3. You get to the lingo of what tax people like to talk about when you go into this area. Okay, so GILTI was originally calculated giving a deemed return on tangible assets. So what we're talking about is a U.S. multinational with a foreign subsidiary. They own that foreign subsidiary, and that's doing business in a non-U.S. country. The U.S. is going to tax that because the U.S. is the owner of that. The U.S. parent is the owner of that foreign subsidiary. So to determine the amount of the foreign subsidiary's earnings that the U.S. would tax, they gave a deemed return on your tangible assets, 10% based on your tangible asset. And then they said everything else was intangible income. Because by definition, if it's not tangible, it has to be intangible. Right? So a rough proxy to determine intangible assets is I'm just going to deem a return on your hard assets, and the rest has to be your intangible assets. And then we gave a deduction against that from at 50% of that. So we tax it currently in the U.S., but less heavily than we do U.S. income. Again, we'll go through the GILTI regime as well. But the One Big Beautiful Bill Act is it eliminated that tangible asset return. Now we're basically tax everything in that foreign subsidiary because we don't offset it with a tangible asset regime. Now, we do set the tax rate a little bit lower, so we give a lower tax deduction against that. These are significant changes that U.S. multinationals are working on right now. This affects everybody. Everybody that's a multinational corporation is dealing with the changes in GILTI. Foreign tax credits. Foreign tax credits in the GILTI regime were limited to 80% of the amount of foreign tax that you pay. So if you paid $100 or 100 in a currency in a foreign jurisdiction of tax, only 80 of that counted as a credit. We raised that to 90% post One Big Beautiful Bill Act. 80% haircut, if you will, the 20% that you didn't get to try to claim a credit on, was always a problem for corporate America. So they got that raised to 90. Okay. Shareholder level expenses, we're going to start in the chapter 2 material, I believe, is sourcing. And so the sourcing of expenses that we'll do when we compute the foreign tax credit was really burdensome for corporate America as well. They had that alleviated as well. So very favorable from a corporate standpoint in this area. The last area I want to mention is the base erosion and anti-abuse tax. The tax rate, so this is when we get to BEAT, you'll find out it's kind of a minimum tax. And that minimum tax was going to go from 10% to 12% under the One Big Beautiful Bill Act law. Now it goes from 10% to 10.5%, so it still goes up, but not as much as it's scheduled to go up. And this 899 was a provision that we used to negotiate with the OECD on the guilty provisions and the interaction, that side-by-side concept I was mentioning on Monday. Secretary Besson of the U.S. Treasury used this threat, which was going to tax foreign companies doing business in the United States more heavily, to get the OECD to accept the U.S. rules. So again, you can see the political maneuvering through the tax code. It's always been there. This administration uses it abundantly to try to get to the right. Okay, I won't cover foreign derived intangible income. We're going to cover that in advanced international tax. Okay, so let's go to our chapter 1 material. We're going to start with some basic principles. So I just want to level set. I just wanted to give you a flavor of the change that's going on right now. Don't be intimidated by change. It's just always there. Just accept it. I had worked with some professionals that were always put off by the change because they're like, wow, I just learned the last piece of legislation. Now I got to learn another thing. I think that's great for young people. If you come into an organization and the law is static, never changes, then you're way behind somebody who's already been there 10 years. But when the One Big Beautiful Bill Act came in, it's like the new cohort that comes into firms and companies, you can learn just as fast as anybody else. You just got to read it, put in the effort. Okay, so we're going to step back from that and go through some basic principles. Then we're going to go through outbound taxation principles and topics and inbound taxation topics. Okay, remember when I say outbound? Outbound, we're sitting here in the United States, so we're going to be thinking about, we're dealing with U.S. clients and U.S. companies. Outbound is the U.S. taxpayers' activities abroad, okay? And that can be individuals and corporations. Okay? It's not your normal individuals. It's not the person that you normally meet, right? But wealthy individuals do have investments abroad, right? They don't just invest in the U.S. stock markets. They might invest in foreign stock markets. They might own businesses abroad. They might do business abroad. They might be in charge of international sales for a company, so they're traveling the world and doing all those types of things. So it can be corporations and individuals when I say U.S. persons. Don't take persons to mean a human being. Persons is defined as corporations as well under the U.S. tax code. We converse that with, or contrast that with inbound taxation. We're again in the United States dealing with U.S. activities and U.S. Taxpayers. But we have a foreign party who's doing business into the United States or investing into the United States, right? There's U.S. tax results for that activity as well. They need help from that perspective. And if it didn't come across on Monday, I'll reiterate it now. That's a very lucrative practice because non-U.S. companies and non-U.S. individuals, the U.S. market is very attractive, right? Big consumer market. Very wealthy country, so you find it very rare that you have a foreign multinational that doesn't have a presence in the United States or want a bigger presence in the United States, and they need lots of help because the U.S. is complicated. had this big piece of legislation. They won't know what that means. Help me understand that. So it's a fantastic practice, either sitting in the United States, which is the latter part of my career, I did a lot of inbound taxation consulting, helping non-US companies invest in the United States. Or if you're in a foreign country and you practice there, helping companies in that country invest in the United States, right? Because they'll be like, I don't know what this bill means. I don't know, they say, I got a notice for this, I got this or that. All kinds of questions, and questions are good for people helping solve problems and getting paid. Okay, always keep in mind outbound, inbound. Okay, tax jurisdiction. Tax jurisdiction is defining a system in which each country defines which persons and what income is subject to tax in their country, right? First, I have to answer who. Who pays tax in my country? And when I say who, it's not just people, businesses as well. And what? What type of income? Is it all of your income? Is it only parts of your income, right? Each country gets to decide that. There is no world tax police, right? I've mentioned the OECD. OECD is a voluntary organization. It doesn't have any law-making capacity, right? They can make recommendations and proposals that might be very appealing, like the Pillar 2 provisions that the representatives from countries then take those templates and proposals and go back home and say, we should do this. It's a great idea. We get this enacted at our country. But in itself, there is no, the United Nations, the OECD, those are just organizations. They have no lawmaking capacity. So what you can imagine here, think of 150 countries in the world, everybody deciding what to tax and whom to tax under their own views of what should be the law. You have this puzzle that doesn't fit perfectly, right? It just doesn't. Each country makes up their own rules, and there's no standardization around that. So a country may look to the personal relationship between the taxpayer and the country in deciding whom to tax. So the United States might sit here and say, okay, of everybody in this room, I'm going to decide whom to tax. So I'm going to look to your personal relationship with the country. Are you a citizen? Are you a permanent resident? Are you a green card holder? Do you have a certain visa? All of those things are the things that you look at with a personal relationship between the person, individual and corporation, and the country at issue. And each country makes up their own decisions as to what they want to do, right? Alternatively, a country may look to the economic relationship between the taxpayer and the country. For instance, what are you doing in my country? Do you have employees? Do you make something in my country? Do you manufacture? Do you have a facility? Do you do sales into my country? Are you sending salespeople into my country, visiting customers and concluding sales? And each country will make their own determination as to where that line is, as to what I'm going to tax. What type of economic activity am I going to tax? Again, everybody makes their own decision. It doesn't fit. There's nobody overseeing the top of it. If you're a sports fan, the analogy is college football, right? Every team's doing whatever they want. Every conference is doing what they want. There's no oversight over the top of it. Same thing in international tax. And I don't think that'll ever change, right? Because this is the crux of choosing who to tax and what to tax is a sovereign decision by each country. Nobody's going to give that up. So when I mentioned like the OECD telling or proposing to the world this is the way we should do things from a taxation standpoint, and I was joking about the Trump administration, that's the most vocal probably in the world, but every country feels like that. It's like, you're telling me who to tax and when to tax it? I figured that out based on what our culture is and what our society decides. So those two things we're just going to keep in mind. Who to tax and what to tax can be personal relationship or economic activity. The problem of double taxation, okay, arises when a taxpayer derives income from one country, which we're gonna call the host country. This is where the activity generating the income came from. It was hosting the activity to generate the income. And has a personal relationship with another country, which we're gonna call the home country. Don't think of it as your, could be where your home, your principal residence, where you live, but it's also where you're doing activity, right? Your home country, where you're headquartered, okay? For an individual, it could be where you live. For a corporation, it could be where the headquarters are, where's the office for the chief executives. So, if I'm in a home country, and the home country says, well, your relationship with me is such that I tax you, and I do business in another country, and that economic relationship trips a threshold in that other country, the host country, and they say, oh, you're doing business here in such a manner that I'm going to tax you as well. That means that one item of income could be taxed twice. That's the double taxation we're talking about. Okay? And remember, my pie I showed on Monday, if I start getting double taxed on income, that gray area starts to push out some of the green area. Corporations are trying to fight against that, right? I want to keep more of my bottom line to invest in my business, right? So the host country is a general matter. Remember I said all countries make up their own rules, but as a general premise, the host country nearly always asserts tax jurisdiction on the basis of economic relationship with the taxpayer. If you are doing business in a country, you will nearly always be considered to be subject to tax in that country. And that makes sense, right? For you to do business in that country, say you're a manufacturing business and you manufacture in Mexico, right? Very common for a U.S. company to manufacture in Mexico. Well, there's roads that you're using for your employees to drive on, roads that you're using for your delivery trucks to move the material around, the legal system that's there, the law enforcement system that's there, the judicial systems that's there if there's a contract dispute. All of that costs money in Mexico. You can't avail yourself of the benefits of that without funding some of the costs of that, right? I think we would all kind of generally agree with that. You don't get all the good things without stepping to the table and paying for some of that. That's the concept of why the host country usually has primacy over taxation. That activity that you're doing costs money in that country, and you need to help support that. So, what that means is the home country may also assert taxation by virtue of the relationship with the home country. My example, I'll stay with the Mexican manufacturer. That's owned by a U.S. company. A U.S. company is subject to U.S. tax. The U.S. says you were organized under U.S. state law, you were subject to U.S. tax. And we understand that Mexico taxes that first. We will see primary right to tax that in Mexico because that's where the economic activity is. So what does the home country do knowing that I've just stepped into double taxation? They provide a foreign tax credit. So when we get to that, you'll see that's where they alleviate the double taxation. But that's what causes double taxation is these two overlapping tax jurisdictional concepts. Host country says, well, you're doing it here, you gotta pay tax. Home country says, well, you're organized here, I need to tax that as well. Usually the home country will then try to alleviate that tax on the basis of that personal relationship. So it's traditionally been left to the home country to alleviate double taxation. So most countries in the world deal with this by not taxing income that is earned outside of their borders. So if I was comparing the UK manufacturer, a UK parented company manufacturing in Mexico versus a US company manufacturing in Mexico, doing the exact same thing. They're car manufacturers. You got Range Rover, Land Rover in the UK, and you got Ford in the US. Both of them are probably making things in Mexico, right? The UK says, okay, UK company, you're subject to tax by virtue of being a UK company, subject to tax in the UK. Mexico, in both instances, says, you're doing things in Mexico. Host country, I'm taxing. UK would say, I'm not going to tax that income completely because it's not in the UK. No instance of double taxation. That's the rule that most of the rest of the world uses. They just choose to only tax income within their borders. Okay? Very few countries try to tax the income outside their borders. The US is the biggest. Why it's always there. It's a big market, so that's why we have to deal with it. But the US steps into the double taxation and tries to alleviate it with the foreign tax credit for any post-country taxes incurred on the foreign income. Okay. I believe China is the same way. I believe China is a foreign tax credit jurisdiction, meaning that if it was China, they would try to tax it as well and alleviate it with credit. Mexico also themselves gives it credit. So if I have a Mexican multinational, then they try to tax everything and alleviate it with credit. But everybody else, most all of Europe, gives that what they call a territorial. I don't tax income earned outside my borders. Okay. So let's talk about U.S. persons. So, yes, George.
Yeah, so I'm asking about there are countries that have agreements, for example, the USMCA, which is an agreement between the US, Canada, and Mexico.
Yeah.
So if you have subsidiaries in those different countries,
Yeah, so great question. So what George is saying is there's a North American trade agreement between Canada and Mexico and the U.S. Now I'm not a trade and customs person, but my belief as to what that agreement actually does is trying to alleviate the free flow of goods across the borders. So no matter what the Trump administration is doing with tariffs, from a perspective, the idea behind that is since we are contiguous countries, we have long borders with each one of them, lots of activity going both ways. U.S. investment outbound, inbound investment from Mexico and Canada, is we want to treat everybody almost as a group and allow the free-flowing goods and people, because that benefits everybody, right? We can do more. So that is not going to directly deal with tax jurisdiction. What will deal with tax jurisdiction is income tax treaties. So you probably have heard about treaties from a conflict perspective, from a war perspective. There's treaties out there that end wars, and think of a treaty as a contract. It is simply a contract between countries. You agree to do this, I agree to do this, you agree not to do that, I agree not to do this, right? And we sign that. That is a contract between countries. We have income tax treaties where countries negotiate the stuff we're going to talk about in this chapter. Who gets to tax who, and when, and what, and at what rate. So I think you have those trade agreements, like you're saying, the multilateral trade agreement with North American countries. I think that deals with more trade and movement of goods, not taxation of those goods. So we have a U.S.-Mexico treaty. We have a U.S.-Canada tax treaty. And you have to read the terms of those, and we cover tax treaties in advanced international taxation, but they have a standard form because there's a model treaty that floats around there. So we start with a template, and then we negotiate it. They're very cumbersome to do. They take a long time. Any of these international agreements take years because people change in office. There's different people, and maybe one party wants to negotiate more than another party, so it's very cumbersome. But there's a series of tax treaties around the world as well that will bear upon the questions that we're talking about now. Great question, because there are trade elements in that as well. We're not talking about trade as much here as the tax effect of the trade. Okay, so what is the tax jurisdiction for outbound activities? Okay, we're in the United States. We're either advising a U.S. company or person, or we're working for a U.S. company or person, and they are investing abroad. What is the U.S.? What do they assert taxation of? So foreign income earned directly by that U.S. person The US taxes that on all income from whatever source is derived. That's the all-encompassing concept. If you remember from individual income tax, if you took that course, that's the same gross income rule we talked about. The US taxes all income of US persons from whatever source derived. Right? You got the power of the pen, you heard me say that. And write it broad. Tax everything. You don't have to ask me if it's included. It's included unless I tell you otherwise. Right? Okay, so all income from whatever source is derived. So what about foreign income earned indirectly? By foreign income earned indirectly by a U.S. person. So what I want you to think about here is income I own directly comes into my income statement, right? Sales, interest, dividends, rents, royalties, those types of things, they're flowing directly into the coffers, if you will, the treasury of the U.S. economy. All taxed unless the U.S. government tells you otherwise. The second section here, what about foreign income I earn indirectly? When you work or advise U.S. multinationals, many times they don't earn the income directly. They have foreign subsidiaries around the world. Those are U.S. parent and then corporations all around the world that they own the stock of. The reason being is because there's a nice reason for having your activities in a corporation in a foreign country as opposed to just doing all the activities directly yourself. Corporate taxation, we'll talk about in the first part of that, about limited liability and those types of things that doing business in corporate form are very appealing from. So, the U.S. also taxes U.S. persons on certain foreign host country income earned directly via a foreign subsidiary. And they do so by application of several special tax provisions that we're going to be covering throughout this course. One is called Subpart F. That is a very old provision. It dates all the way back, you guys won't even know what these years are, back to the 1960s. President Kennedy, that administration enacted the Subpart F provision. We'll go through exactly what those provisions are. The second is this Global Intangible Low Taxed Income. The acronym is GILTI. That also picks up a bunch of that indirectly earned income and taxes it immediately in the U.S. And then we have 100% dividends received. We'll be going through all of this throughout the course. I'm just giving you a framework. So we tax everything you own directly as a U.S. individual or a U.S. corporation. And then if you're doing business abroad in corporate form, we also tax that income via these special regimes. So, what I started off with, you have foreign countries as the host country. Think about all my foreign subsidiaries. Those are all host countries. I'm doing business in there. I'm either doing sales, I got sales subsidiaries, I got manufacturing subsidiaries. Something going on in that business, that foreign country is going to tax it. I'm just telling you here, the U.S. is going to tax it as well. Double taxation. If you also took taxation of individuals, we talked a little bit about double taxation from corporate earnings. So, a corporation pays tax as an entity. It's a separate tax-paying entity. When it makes a distribution of its after corporate tax earnings, the shareholder has dividend income, they pay tax on it again. That's double taxation. Right? That's just a function of doing business in corporate form and making dividend distributions. 2 layers of tax on 1 layer of corporate income. This is completely separate and apart from this. This is double taxation because 2 jurisdictions are trying to tax the same thing. What?
I'm just trying to reconcile what
Yeah.
you said about most countries, including the U.S., not trying to apply double taxation.
Yeah.
This is what you were saying about doing double taxation. So I'm a bit confused as to what is the actual scenario. Because in my mind, when you say tax, everything is taxed. I thought you mean everything is, all income is factored in, but some would be above the line and so not taxed as opposed to actually taxing.
Okay. Fair question. Let me see if I can clarify a little bit. So, first of all, most countries don't have the second part of this slide. They don't tax indirect earnings earned via foreign subsidiary. My UK doing manufacturing in Mexico, example. The UK says, well, it's done in Mexico, I don't tax that. So you don't step into the problem and try to fix it with the foreign tax credit. The US steps into the problem because of this slide and tries to fix it with the foreign tax credit. Okay? And that's just the choice that we've made. For decades, we've always been a foreign tax credit jurisdiction. Other countries say, well, that's silly. You're step into a problem only to try to fix it. Now, as an advisor, I kind of like that. Because, let's create a problem and then work really hard to fix it. It's like, oh, that sounds good. It sounds like work, right? It's just the perspective of the countries as to how they want to do it. Now, if I was writing the rules from a blank sheet of paper, I think the easiest one is to don't tax things outside your border. You never have a foreign tax credit situation. You don't have your companies calling you and saying, well, I'm getting double taxed on this in this country. Well, I don't tax that, so that's not my problem. I don't even touch it, so you only have one layer of tax. Whereas this invites problems.
So, is this, okay, I think now I get it. So all gross income is factored in and taxed, but a credit is then applied
Yes.
to alleviate the double taxation.
Yes. So what'll happen is, if I have one of these types of income in my foreign subsidiary, it is going to be taxed in the United States on the regular tax return with everything I'm doing domestically in the United States. Times 21%, here's your tax. Then there's a whole section that says credits. And remember, from individual, a credit is a dollar for dollar benefit because I'm basically paying my tax with a credit. One of the credits here in the corporate world that's really, really important is a foreign tax credit. But it sounds doable in concept, it's incredibly complicated in practice.
And in your hypothetical scenario where foreign income wasn't taxed at all, that would be, say, above the line.
It's just not even on the tax return. It's just not even in there. So that UK company would just do all, their page one of their tax return is going to be all UK activities. Income, expenses, times the UK tax rate, done. What you're doing in Mexico, they're like, go talk to Mexico about that. That's not my concern. The US, I think, has always just viewed that all this stuff, by virtue of a US parent on top, I am concerned about all that stuff. I should be able to tax all of that. Yeah.
I'm a little confused on the role of the provisions. Do those allow the U.S. to tax it by avoiding double taxation? The dividends received deduction, isn't that them not taxing it?
Yes, great question. So the 100% dividends received deduction. So what that means is the dividend is taxed, but they give you a deduction for the exact amount that was subject to tax. So if that's 100%, it's exactly like Holly's saying. It's in and then it's out, nets to zero, I don't care. The problem is you don't get to that. I should have put 1, 2, and 3 by subpart F, guilty and 100%, because you got to go through them in cascading order. And the number that finally survives when you get down to the 100% dividends received deduction is very small. 2025 prior, 2026 further, it's virtually non-existent. So it's in corporate America wanted this originally, this 100% dividends received deduction, to equate to that situation of the UK. Why don't tax this? And so what's the best way for you to do it is to tax it, put it in income, but give me 100% dividends received deduction. If that makes you sleep better, fine. It doesn't have any effect on my taxable income. But we stack these things up on top that basically include everything, and so there's very little left over for the 100% dividends received deduction. When we first got this legislation in 2017, we're like, yeah, we're getting in line with the rest of the world. We're gonna have 100% non-tax of foreign activities. And then you read the legislation, you're like, wow, that was really cute. You gave us something, but it's like, I make this much and it really only counts that much as I get 100% dividends received deduction.
I have a question still about within the boundaries of the U.S. Let's say I'm a foreign entity and I don't have a tangible store within the United States, but I sell stuff online. Is that still within the boundaries of the US?
Great question, great question. So, the historical standards are physical. Bricks and mortar, so facilities, like manufacturing, retail stores, you know, real things I can go out and touch. That would cause the US to say, well, if you're H&M, which I think is a UK company, if you got an H&M store in malls in the United States, you're subject to tax, because I can find you. Absent that, if you're doing stuff online, the historical standards would say, no, you're not subject to tax. But the US also has domestic law. So we have treaties that, like George was saying, or questioning, we have treaties that tell you how much you can do when you meet that threshold. Those are usually the physical standards. If you don't have a treaty with that country, then that means you're just left to US domestic statutory law. And that's a lower threshold. And so the US is not as vigorous, I'll say, on arguing that a non-physical presence results in tax as the rest of the world. Why? Because where are the companies that are doing that non-physical activity located, principally? US big tech companies, big Amazon, big Google. These companies are doing business around the world. So who's it upsetting? It's upsetting France, the UK, where they're doing all these activities without physical presence here. They're already in the United States. We already tax everything they got. So we don't, it'd be a non-US tech company doing activities in the United States without a physical presence. And that's just, it's less of an issue for us as it is for other countries, I think, because of our company.
How would it work from like an ad perspective if like Google had like an ad that was run from like a foreign country company, but run into the United States? How would that be like taxed?
Yeah, so first of all, that'd probably be a pretty rare fact pattern because Google's US, and so why would they run the ad through a non-US Google subsidiary into the United States? But if they would, then the issue would be is that foreign subsidiary, how is its income run through these filters down below? As it's subpart F, realizing you don't know what that is, guilty, you don't know what that is yet, but those would probably pick it up and tax it anyway. So Google, being well advised, would probably just do that activity from the US because they know, hey, I'm going to pay tax anyway on it. Just keep it simple. Right. But yeah, it's all these crazy fact patterns that come up that you have to then apply these rules. Great questions. Okay, so then the foreign tax credit, as we mentioned. So we're talking about US persons outbound. So we have host country, we're trying to tax it because you're doing business there. And home country, US, is trying to tax it by virtue of their personal relationship with that individual. To mitigate that exposure, or directly or indirectly, we give a foreign tax credit. The big first topics that we're going to cover is the foreign tax credit. And that effectively limits US taxation to the US tax rate that would have applied to the host country earnings as computed under special US tax rules. So we'll go through those special US tax rules, but that's the way the US steps into the problem and tries to alleviate the problem. What corporate America says is it's just messy. It's just messy. It doesn't work perfectly. I don't get a perfect offset. And we'll talk about the components when we get into the foreign tax credit, why that is the case. But it just, the system just doesn't work perfectly. Okay. So that was tax jurisdiction from an outbound perspective. U.S. companies doing stuff abroad. What is the tax jurisdiction from an inbound perspective? Non-U.S. person investing into the United States or doing business activity in the United States. What are the, so the U.S. uses two approaches to tax U.S. source income of non-U.S. or foreign persons, which includes non-resident alien individuals and foreign corporations. So again, persons is not just humans, it's businesses, right? Based on their type of investment. So we have to look at what are you doing relative to the United States. If you are doing business and driving business income from the United States, so you have This could be as straightforward as a non-US business forms a US corporation subsidiary and does their business. Like, they start making things in the United States from a building perspective, or they sell stuff in the United States. Okay? It's extremely simple there. You are subject to US tax because that's a US corporation. Right? We tax all US corporations in the United States. What we don't tax is the foreign stuff. Think of a sovereignty perspective. We don't have any jurisdiction over that company. I'll stick with Land Rover, UK car manufacturer. There's Land Rover dealerships all over the United States, right? They are clearly subject to US on all their US sales activity. But they're selling Land Rovers and Range Rovers in the UK and Europe and everywhere else. That's not in the US. So that differs from Ford. Ford is a US company doing the same thing. We tax everything for Ford because the top of the org structure is a US company. If the top of the org structure is a non-US company, we don't get to tax them on everything. We don't have jurisdiction, right? They're not formed under US law. That's somebody else's responsibility and right to do that, okay? So, alls we can tax is what you're doing in the United States. Because in that instance, we are the host country. We are hosting you doing that activity in our country, so we'll tax that activity. So that business income is always subject to tax. The easy thing is it's just like corporate taxation. Everything in that course where you have gross income, you have revenue, you have expenses, taxable income times 21% is exactly the same for Ford as it is for Land Rover's US business, right? No special tax rate, no special rules. You're just subject to US tax because you chose to do business. Now, if I do a little bit less, sorry, George, go ahead.
So does the subsidiary have, should it have presence, physical presence in the US?
Most likely, yes. Most likely, yes, because you'd have to be doing something here, right? And so usually that is the case. Now, I don't want to say that's the only case, but that's the 95% of the cases is there's actually physical activity here. Like you're trying to sell Range Rovers into the United States, right? So you got to be here. Or you're making something here because it's too big and heavy to make in Asia and have it shipped over here. It costs too much, so I just make it in Iowa, right? You're doing that type of activity. You're just doing that in the U.S. You're doing business activity.
So I'm wondering if, for example, my company is doing taxes for people. Has a significant kind of that market in the US, but it's physically not here. So I'm doing it online.
Yes. Yes. So, you're doing tax returns for U.S. taxpayers filing tax returns, but you're doing it abroad.
Maybe I based myself somewhere, maybe.
Yeah. So, I would think there, and your employer is abroad, right? Not a U.S. company. Good. So, what I'm trying to do is, you got to distance yourself from these connections to the U.S. So, let's say I have a fact pattern where I have a non-U.S. employer doing activities outside the United States, but for U.S. individuals, okay? Because you're doing their tax returns and they're going to end up getting the tax return, signing it, and sending it in to the U.S. federal government. I think there, your question would be in number 2, because you're going to get compensated somehow, you or your company, right? The U.S. person, if your business was doing my tax return, you're going to ask me for money because you provided a service. So when I make that payment, I have made a payment from the U.S. to a non-U.S. employer for the services that you guys provided to me. The question would be, in that second category, is there U.S. withholding tax on that payment? Okay? No different than if you were a non-U.S. person investing in the U.S. stock market, or if you were a non-U.S. lender who was lending to a U.S. borrower who was getting interest paid from the U.S. abroad. Those outbound payments are more investment type activities. The issue there is withholding, right? I can't tax you on your business income because you're not doing anything in the United States, but you're getting paid from the United States. So the question becomes is that a withholdable payment? I would think in your fact pattern, you're probably not. The reason being because I will characterize that payment as a service payment. When we talk about sourcing, we source service income to the place of location of the service. And if you're doing that in Nigeria, that's not US. It's not US source payment, we don't withhold from it. Now, if you are coming to the United States occasionally to meet customers and clients, staying for 2 months during tax season in the United States, now you're starting to get US source service payments. You might withhold on that. Okay, so great question. Just took me a little while because you got to sort through all that. But these are the two buckets. You're either full-fledged doing business in the United States, manufacturing, sales, or services, boots on the ground, doing things, or you're more passive. You're doing investment activities. Think about dividends, which come from stock investments. So you own stock in the New York Stock Exchange or the NASDAQ. You're getting dividends from that. Or you're a lender. You're getting interest payments paid from the U.S. to a foreign lender. It could be royalties. So if you're a foreign company and you have intellectual property and you're licensing that into the United States and a customer's paying you a royalty, that's an outbound payment. Is that withholdable? So it becomes withholding. And so the trick with withholding is first I have to source it, which I just did, having a conversation with George. So we will go through sourcing here in the next chapter or so, but it's either US or foreign. So the good thing about sourcing is, from a sourcing perspective, it's binary. It's either US or it's not US. Okay? I only withhold on US source payments. And it's not necessarily looking at where does the payment come from. We have rules around each type of payment. We'll go through that. And you just have to cut through the noise. It took me a little while to cut through the noise of the fact pattern that was posed to me. But that was a service payment. I'm paying for somebody to do my tax return. Right? And I remember, the service sourcing rule is place of performance of the service. So where is the person sitting that's doing that? As opposed to being outside the United States, that would be a foreign source payment. I don't have U.S. withholding tax because I only withhold on U.S. source. Okay. So those are the two buckets we're looking at. Either very intrusive business activity or more of a passive investment activity. The reason we do the second is because the U.S. is a very popular investment location, right? All kinds of non-U.S. holders of U.S. stock. Those dividends that go out, the U.S. might want to withhold. The thing on the second bucket, the withholding, we'll talk about this in the next couple of class periods, but the U.S. statutory withholding rate is 30%. What that means is if you're a non-U.S. person and you own stock of a U.S. company and they pay you a $100 dividend, you get $70 of it. The other 30 goes to the U.S. federal government. And the payor is the one who's the withholding agent. They're the ones who withhold that and remit it to the U.S. federal government. Those tax treaties I mentioned, agreements between two countries, they will negotiate down that withholding tax rate, many times to zero. Like the US-UK, I'm pretty sure the dividend withholding rate is zero. What that means is UK investors can invest in the US stock market and get a dividend. In that example, they would get the full $100, not the $70. The US uses that as a carrot in the negotiation of the treaty. They know the country wants to invest in the United States much, if not more, than we want to invest in the UK. I'll lower that withholding tax rate to get something else in the tax treaty that I want. Okay, so starts off at 30, can be negotiated down lower depending on whether your country has a tax treaty with the United States. Okay, so we'll talk about sourcing rules. We're going to go into detail on that, but I just want to introduce that here. So this is for outbound and inbound. Okay, so whether I'm advising a U.S. company or a non-U.S. party, I need to source these payments. So the source of income and expense rules play an important role in the computation of the foreign tax credit applicable to U.S. persons investing abroad. So I need to know that foreign tax credit I give, it's subject to a limitation. And the limitation is premised on the U.S. comes in and recomputes the foreign income that is actually subject to foreign tax. Now, we don't redo the foreign tax return because that's the foreign country. You're going to have employed a foreign advisor or a foreign individual or two to help you file that tax return. But the U.S. comes in and says, well, we think this is the way tax should be computed. Now, you can call that arrogant or what have you, but the U.S. puts their own view on how taxable income should be determined. Okay? So we will recompute, in quotes, the foreign taxable income, and then we will give a credit of 21% against that fictional computation. That's the foreign tax credit limitation. Now, whether you paid more or less foreign tax than that limitation, that's where you get to have, where you pay too much foreign tax or not enough foreign tax. And if you pay too much foreign tax than what the U.S. will let you credit, that's excess credits. That is a tax attribute that's very important in tax accounting. Because we'll let you use that credit, 1 year retroactively and 10 years prospectively. You're back one, forward 10. We'll go through all that when we talk about foreign tax credits. If I have paid less foreign tax than 21% of this recomputed foreign income tax liability, the U.S. taxes the rest of it. It gets us up to 21. The U.S. thinks that every U.S. multinational should pay 21%. Remember the pie should be equal to 21%. We'll allow the foreign country to take off some of that gray slice of that pie from the U.S. government because we are going to effectively give them primary right to tax that host country foreign income. But if they don't tax it as highly as the U.S. thinks they should, to 21, the U.S. fills in the difference. You come up to 21. We'll go through all of that detail. Okay, so the sourcing rules, so we have to do income and expenses when we get there. So income vary depending on the type of gross income. So we have different rules if the stream of income is interest, dividends, service, rents, royalties, sales of inventory, and gains on the disposition of real personal property. So when I was talking to George, we were dealing with services. Special rule talks about place of performance. That's different for dividends. Dividends is the residence of the payor of the dividend. We'll go through all that when we get to the details. I have to go by item of income. What's the rule? What's the rule? What's the rule? These are U.S. rules. Okay. Then the sourcing rules for expenses require taxpayers to allocate and apportion expenses between U.S. sources and foreign sources, gross income. So we have a very factual connection, like where does the expense, what income item does it derive, right? If I have a salesperson's expense, what income stream drives that? Is it this product sale? Is it the services that we're talking about in George's situation? But what does the expense relate to? A causal connection, okay? That's our general rule for expenses. Then we have very specific rules for certain types of expenses, which is interest expense and research and experimental expenses. We have very special rules there. So we have a causal connection generally for expenses. We put those into U.S. sources and foreign sources. And then we have very special expenses, interest, and R&E that we have rules that they tell us exactly what to do. We'll go through all that. But I'm trying to get to a U.S. source net taxable income and a foreign source taxable income. So I need to deal with the income and I need to deal with all the expenses. I like to think of it as, think of an income statement. I have income and expenses and I have net income. If I put a U.S. column and a foreign column, non-U.S. column, everything in that first column has to go into one of those two. It doesn't go into outer space. And I don't have to do it by 20 countries. I just got to go US and non-US. And then I foot those two columns. That's my US taxable income, and that's my foreign source taxable income. Big picture, that's where we're headed in the foreign tax credit world. That's what you're trying to do. Okay. There's some traditional government international tax policy objectives. This is a little bit politically wonky, if you will, but this is the perspectives of governments, and it's why it gets to these points of foreign tax credit versus not taxing something outside your country. What led countries to make those types of decisions? And these are very politically motivated perspectives. Okay, so the first one is they got crazy names, but you'll hear these names, so I want to just go through them. Capital export neutrality. Okay, what this means is decisions to invest at home or abroad should be unaffected by taxation. So capital. Do you invest it in the United States or do you export it and invest it abroad? Neutrality, meaning that taxes does not sway your decision. If you are your pure perspective is capital export neutrality, you want businesses to decide whether they invest in their home country or the host country, irrespective of tax. So go where the customers are, go where the raw materials are, go where the best workforce is, go what's closest to you, whatever makes sense for your business. We want tax to not sway that decision. Okay? The U.S. In the Trump 1.0 Tax Cuts and Jobs Act, we went from a flat, single corporate tax rate of 35% down to 21%, which is where we are today. That's a huge drop. That's 14 hard percentage points, but almost half, right? More than, no, not half, almost half. 35% to 21%. So that corporate tax rate took us from the highest in the world to closer to the middle. And the perspective of is the U.S. wasn't competitive. That decision to invest abroad or at home was being swayed by tax. Because if I do that same activity in the United States, I pay tax at 35%. If I do that tax in Mexico, I pay tax at 25%, because that's the Mexican tax rate. That's going to influence that decision on where I put that capital. So the Republicans came into power in 2016 and said, we need to make the U.S. more competitive. Get the corporate tax rate down. It doesn't have to be the lowest in the world, because we have a lot of other things that are appealing about the U.S. We just need to be competitive. So get it down to the middle. That was the impetus behind 35 to 21. And so that alleviated some of the tax incentive for U.S. companies in favor of investing outside the U.S. as opposed to inside the U.S. in seeking to lower your global tax expense. Right? Hopefully we have the benefit of hindsight. You can feel what the administration, why they would have been behind this, right? It's because they were trying to increase investment in the United States from multinationals. Yes, ma'am?
Sorry, I was just confused. So this made them, like, U.S.-based companies favor investing in the U.S.?
Correct. Correct, exactly. By making tax results more neutralized, right? You don't have to be the lowest cost jurisdiction in the world from a tax perspective, but just not the highest. 35 was really out of line with the rest of the world. Like the UK is 19, Mexico's 25, China's 25 or 20, I believe. So the US was really high, sitting there at 35. Now we had a lot of things that offset that. Capital markets, educated workforce, lots of great things going for us. But how much did that outweigh the tax cost in making a decision if you were a capital allocator from a business? Okay, let's contrast that with capital import neutrality. So what this stands for as a proposition is all taxpayers operating within a country should incur the same total rate of tax on that income. Okay? Fairness perspective, competitiveness perspective. My example of the UK doing business in Mexico, if the UK doesn't tax that, that Mexican business is paying the same rate of tax as a standalone Mexican company doing the same activity in Mexico. Completely competitive, just because I'm UK owned. Now, if I contrast that with a US company doing the same activity in Mexico, we have this foreign tax credit, and what if it doesn't work perfectly and I have some double taxation? Guess what? Who's least competitive in that situation? I have three parties. I have the UK-owned Mexican operation, I have the standalone Mexican operation, and I have a US-owned Mexican operation. The US-owned Mexican operation is least competitive because they pay more tax. If I have some residual US tax on that activity, I don't have that in the UK, and I don't have that for a standalone Mexican company. So I have violated capital import neutrality. This concept that all businesses should be paying the same rate of tax on the same income. Right? That's very powerful for the rest of the world when they don't tax things outside their border. They don't layer on any headquarter type jurisdictional tax that the US does. Okay? So this is very impactful to businesses, and it will appeal to politicians when business leaders are talking to politicians and say, I am not competitive around the world because of your tax code. What does that mean? That means I can't hire more people. I can't invest more in the United States. I can't do more R&D because you're taxing me more so than my competitors around the world. That gets people's attention. That competitive nature is a very important aspect. So I'm not saying either one of these things is perfect. It shifts over time. And they're usually part and parcel. Parts of them are in each country's decisions as to what they make. But these are more theoretical, pure perspectives as to what should be the goals of taxation. Okay. Okay. Just to finish this off, the U.S. international tax system exhibits notions of both capital export and capital import neutrality. For example, subjecting U.S. persons to U.S. taxation on their worldwide profits is indicative of capital export neutrality. What did I say that was? Decisions to invest at home or abroad should be unaffected by taxation. If the U.S. taxes everything you do up to their tax rate, then in theory, you're unaffected by taxation because you know you're going to pay 21% as a corporation, whether I do business here or elsewhere, right? That's an example of capital export neutrality. Exempting dividends of routine earnings, so that the concept that I was talking about with Holly about 100% dividends received deduction. If my income got to that baseline, so it was eligible for 100% dividends received deduction, that's an example of capital import neutrality. Because the U.S., for that segment of income, I'm not taxing it. So I'm very equivalent to the Land Rover example of operating in Mexico. They just choose not to tax it. I tax it, but I give you 100% dividends received deduction on it. So that concept rings of capital import neutrality. My foreign operations are subject to tax on the same rate of income as anybody else in that. The taxation of U.S. trade or business income earned by a non-U.S. person at the same rates of U.S. tax applied to the U.S. trade or business earned by a U.S. person is indicative of capital import neutrality. So if I have a foreign owner of a U.S. business, and I remember I told you it files a U.S. tax return like a corporation, looks exactly the same. Revenue, expenses, taxable income times 21%. That looks like capital import neutrality, right? Everything I'm doing in the United States is taxed at 21. So the U.S. is a hodgepodge of these things, and that's just politicians making decisions over time as to how they want to structure the system. Okay. Tensions created by the trade-offs between the two types of tax policy objectives is the subject of ongoing political debate. Should I be using the tax code to incentivize U.S. activity? That's going on right now. And it's not a tax issue, but tariffs as well is doing the same thing, right? If I hit a company that's importing a product into the United States with a big tariff, What I'm doing is I'm choosing, because if I have a US competitor doing the same product, they're not subject to the tariff because it didn't come from abroad. I'm doing the same thing. I'm trying to influence behavior through the law. So they do that through the income tax code as well. So some lawmakers and constituencies wish to emphasize capital export neutrality, seeking to mitigate tax inducements to locate jobs and investments abroad instead of the United States. That was the whole reason from going from 35 to 21. Is trying not to incentivize building the next plant outside the United States because it's taxed less heavily, because we were at 35. If we lower that to 21, business leaders are going to say, maybe I'll build that next facility in Missouri. Hire Missouri people to do it. Okay? Now, I put here, the Trump administration has implemented tax policies intended not just to go neutral, but to incentivize U.S. investments. So they weren't willing to stop just at, let's make it neutral, make tax neutral. Let's go on the other side of the formula and incentivize you to do it in the United States. So the president, has had various proposals, got some of them enacted in these pieces of legislation, to where we'll tax that U.S. activity less heavily. That's violating capital export neutrality, because now I went from favoring investment abroad versus the U.S. to favoring U.S. investment versus investing abroad. That's a very important thing in this administration. Others may emphasize capital import neutrality, which focuses on the competitiveness of our U.S. businesses. Because I think most economists, most business people would say, if my U.S. business is more competitive abroad, more successful ultimately abroad, that is better for the United States. That means executives are here in the United States. That means the business is bigger here in the United States. The R&D function is bigger in the United States. The investment opportunity both into that company and from that company are better if they're successful abroad. So I need to make sure that my tax rules allow my U.S. businesses to compete effectively abroad. And companies make sure that the politicians know in instances where that's not the case. So you see this tension between the two, and it's fascinating. When you understand this and see how, it took me about 3 or 4 years when I put all the pieces together of how our rules actually work, and then the political landscape and how it influences behind the scenes. But I will guarantee you there will come a time when we'll have a Democratic president and Democratic legislature. Their views are going to come through, and they will no doubt make changes, because as I mentioned, the last 2 seminal pieces of tax legislation, they did not get 1 Democratic vote. There's a pent-up demand as to what they want to get done, and these things will change behind the scenes on that. Okay, so we'll continue with this, and then we'll jump into Chapter 2. I believe Chapter 2 is the sourcing material that will go into detail by income item and expense. Okay, thank you. What I normally do for those of you that haven't had my courses before, I send out at the end of the week what we'll be working on the following week, and we don't have class Monday. You guys know that, right? But I'll tell you what we'll be doing on Wednesday, so you guys you have plenty of time to read material for next Wednesday, okay? I don't want to preset how we progress through the class. We'll go on our own pace. Okay? Thank you.
I was quicker than yesterday. No, I'm saying first one yesterday.
啊，我知道，但没事儿，就是只要它没问题就行。用非无此。20，因为你30楼车价格只有我以前卖过一些其中的差的。
Hi. Oh, this one.
So,